In the recent announcement of the United States real GDP preliminary figures for the first quarter, widespread attention was drawn as the data indicated a year-over-year seasonally adjusted annual growth rate of just 1.6%. This marked the lowest level in nearly 2 years and fell significantly short of the market expectation of 2.5%, compared to 3.4% in the previous quarter. On another front, the preliminary personal consumption expenditures, PCE, grew at an annualized rate of 2.5% quarter-over-quarter, a notable slowdown from the previous rate of 3.3% and below the expected 3%. However, the core PCE price index, excluding food and energy, rose by 3.7% on an annualized quarter-over-quarter basis, exceeding the anticipated 3.4%, indicating that core inflation remains stubborn. Following the data release, the market reacted strongly, with the yield on 10-year U.S. Treasury bonds surpassing 4.7% during trading for the first time in over 5 months. Amid a prevailing sense of gloom, it appears that the prospect of an interest rate cut is increasingly distant. This situation is primarily attributed to the slowdown in consumer spending and the persistence of inflation in the services sector. As a vital pillar of the economy, consumer spending in the first quarter increased by 2.5%, below the growth rate of 3.3% from the previous quarter and the expected 3%. Spending on services grew by 4%, the highest quarterly level since the third quarter of 2021. Inflation saw a significant rebound, with services inflation excluding housing and energy rising by 5.1%, nearly double the rate from the previous quarter. Nonetheless, there are some positive signals. Residential investment increased by 13.9% year-over-year in the first quarter, driven by real estate commissions, other property transfer costs, and new single-family housing constructions, indicating a gradual recovery in the real estate market. Against this backdrop, expectations of a rate cut have once again become a focal point in the market. Data suggests there is an approximately 80% chance that the Federal Reserve will initiate its first rate cut in September. The likelihood of a 50 basis point cut over the year is around 40%, and a 25 basis point cut around 60%. This indicates that despite slower economic growth, inflationary pressures persist, and the Fed may not act hastily. Economists are divided on this issue. The chief economist at LPL Financial, Roche, believes that as overall demand slows, inflation will ease this year, but remains far from the Fed's 2% target. Meanwhile, other analysts suggest that the disappointing economic performance in the first quarter might soften the stance of Fed officials. Previously, due to an acceleration in the consumer price index in the first quarter, Fed officials had indicated they were not in a rush to cut rates. The economy is expected to weaken significantly later this year, while inflation is likely to decline swiftly, potentially enabling multiple rate cuts by the Fed.